Welcome to our session on Bitcoin ETFs. Today, we're going to unravel the complexities of Bitcoin ETFs and understand how they're transforming the investment landscape. Let's start at the beginning. An ETF, or exchange-traded fund, is a type of investment fund traded on stock exchanges. They offer diversification and are accessible like stocks. Understanding this is key to grasping Bitcoin ETFs. To appreciate Bitcoin ETFs, it's essential to understand the roots and mechanics of traditional ETFs. ETFs, or exchange-traded funds, were introduced in the early 1990s as a hybrid of mutual funds and stocks. They were designed to combine the diversification benefits of mutual funds with the ease of trading of individual stocks. An ETF tracks an index, a commodity, bonds, or a basket of assets like an index fund, but trades like a stock on an exchange. This means ETFs experience price changes throughout the day as they are bought and sold. ETFs are known for their lower expense ratios and fewer broker commissions than buying the stocks individually. Over the years, ETFs have evolved, introducing various sectors, commodities, and now digital currencies like Bitcoin, making them accessible to a broader range of investors. Bitcoin ETFs are a bridge between the traditional financial world and the emerging digital currency space. They allow investors to gain exposure to Bitcoin's price movements without the complexities of direct cryptocurrency dealings. There are two primary types of Bitcoin ETFs: physically backed, which hold actual Bitcoins, and futures-based, which invest in Bitcoin futures contracts. The former closely tracks the actual price of Bitcoin, while the latter bets on future price movements. Bitcoin ETFs trade on traditional stock exchanges. This means investors can buy and sell shares of Bitcoin ETFs just like they would any other stock, making Bitcoin investment accessible to a broader audience. While Bitcoin ETFs offer advantages like accessibility and regulatory oversight, they also inherit the risks of Bitcoin, including its price volatility and evolving regulatory landscape. As of now, the landscape of Bitcoin ETFs is dynamic, with varying performances and growing interest. The future promises more developments as cryptocurrency becomes more mainstream. The emergence of Bitcoin ETFs carries significant implications for Bitcoin itself. First and foremost, Bitcoin ETFs could vastly increase Bitcoin's exposure and adoption. By packaging Bitcoin into a familiar investment vehicle, these ETFs make it more accessible to a broader, more traditional investor base. This could lead to increased investment from both retail and institutional investors, potentially enhancing Bitcoin's liquidity and market capitalization. Moreover, as Bitcoin ETFs gain traction, they could contribute to the legitimization and stabilization of Bitcoin as an asset class. This can have a ripple effect on the entire cryptocurrency market, elevating the status and understanding of digital currencies. However, it's crucial to note that this increased exposure also brings Bitcoin under greater scrutiny from regulators and market analysts, which could lead to more regulatory interventions. In essence, Bitcoin ETFs are not just a new investment vehicle, but also a catalyst. In conclusion, Bitcoin ETFs are an innovative and evolving investment avenue. It's important to understand that none of this constitutes investment advice. This video is provided as an education resource only. We encourage you to continue researching and consult with financial advisors to make informed decisions.